Good evening, ladies and gentlemen. Today, I want to take you through what is going on with the Canadian economy versus the U.S. economy, especially after the financial institutions, our major Canadian banks, the largest companies in Canada, posted earnings. And it's still a not so rosy photos with the increase of loan loss provisions. But we will go over my favorite Canadian ETFs because they've been crushing over the U.S. And we're just going to dive into so much more in between. So if you're on a path to financial independence, if you damn well one day want to retire early, consider subscribing. Join me on that journey here, folks, because first and foremost, look at the sector performance comparables between the US and Canada. This is really interesting considering, as of kind of May here, we can see that information and technology has really led the way, but not by like absolutely absurd amounts. And we're going to see that when we actually look at the broader overview because man, if you take a look at the US and you look at a heat map just by market cap, it is really spattered this year. I mean, to throw a dart isn't as easy as it was. You're not making money on everything right now, but if you look at these red stocks, maybe some dip buying opportunities, depending on, I mean, it's crazy that year to date, I mean, Apple's still down 19%. Nvidia's almost flat, but still Microsoft been a leader here. Probably what I want to talk about way toward the end here is just my comparables between Microsoft and Google. But if we just do a quick look at the Canadian side of it, it's dramatically different because our best performing sectors have been materials, which comes down to the commodity space, not commodities per se. We're not talking about like oil, but more or less we're talking about like minerals, gold, uranium, all that stuff has been exploding this year. So you're up like 43.2%. I mean, you take a look next is utilities, healthcare, information technology is like the smallest performing sector. Again, comparable to the United States, consumer discretionary communication services, oddly enough, probably in a bit of a recovery here, the communication side of things like Verizon for them. But overall, I mean, the financials aren't performing great. Utilities aren't on fire. Real estate's barely done anything in the US, and healthcare has been absolutely decimated. Whereas in Canada, it's been consumer discretionary energy and communication services that have been not doing so well this year. So our healthcare and minerals and utilities are far outweighing what's going on in the United States. It's really weird seeing the differences between our two economies. And if we take a look, you could have threw a dart at a board in the Canadian economy and have pretty much made money. Like you'd be sparse to find any stock that is down like massively, but I mean, you had a good chance of picking any sector and doing relatively okay. I mean, the Canadian economy has been on an absolutely tear. If we take a look at the sectors here as well in Canada, you can kind of see the mineral sector here. I mean, some of these stocks are 40+%, 50%. I'm not playing these obviously because I think there's cyclicality to them, but man, what a good time. It should have been so obvious. There's things that should have been obvious, like when they raised interest rates, the best thing you could have bought was insurance companies because any company that sat on a massive amount of cash. Same thing should have been said when gold was skyrocketing. Hey, like we should be buying these gold companies before they post their quarterly earnings because a lot of them have been shooting up pretty dramatically. And if we just take a look comparably, it's neat to see that, with all the confusion, all the geopolitics, if you do VCE, which basically represents Canada's largest companies in a market cap weighted ETF versus the S&P 500's VOO. Year to date, Canada, and again, we have a much higher dividend on VCE. I think it's closer to 3%. But even still, it's up 6.21%. The S&P is up 0.5%. You zoom out on the 1 year, the Canadian economy, it's up 19% versus the S&P is up 11%. Again, keep in mind there's almost a 2.5% higher yield you're probably getting off that. So, you're still up over 20% at least, right? And if you zoom out on the 5 years, this is where you get a bit of a disconnect, but it's really not that far off. And a lot of times, Canada was actually, overtaking the S&P 500. So there's something weird going on here, and it's really related to the volatility in tech and how you feel about the valuation of tech, because it's been the primary driver of what's going on in the United States. And Canada is just getting this benefit of our financials and, the mineral sector. But that only recently happened, right? Like minerals weren't really that on fire up to like the last little bit, but even still, it's kind of crazy, right? So if we zoom in a little bit more to the economies themselves, the gross domestic product sale in the United States is starting to drop off. Actually, this could be the first president to ever put the U.S. economy in a recession in a very long time. And that's what they're teetering on, right? 2 quarters of negative GDP is a technical recession. Gross domestic product sales are just transactions me and you are making. Anytime money crosses our hands, it's considered gross domestic product sales, right? So you can see it went negative in the United States for Q1. But if you take a look at Canada, Canada actually grew pretty dramatically by 2.2% in the first quarter. And it's actually led the Bank of Canada to take a bit of a pause on perhaps doing rate cuts right now. just because GDP is so strong. But that was for Q1, and a lot of that anticipation where that growth came from was basically had a lot to do with people kind of front running tariffs, apparently, and a lot of that because they're saying gross domestic product grew annualized pace of 2.2%. Statistics Canada reported Friday morning. That's higher than the agency's early estimate of 1.5% and economist consensus of 1.7%. The key points here is that GDP figures are sending no obvious distress signals so far in 2025, according to a BMO economist. And he pointed out that Canada's economy was among the top performers in the G7 as GDP dropped in both the United States and Japan the last quarter. With this sturdy set of results, we are officially abandoning our call of the Bank of Canada cut rates next week. This is coming from RBC. Canada exports more cars, industrial machinery, equipment, and parts in the first quarter. StatCan said at the same time, imports for those kind of goods rose, which is intriguing. The threats of tariffs can be expected to influence trading partners and incite, obviously, importers to increase shipments prior to these tariffs being implemented and avoid additional cost. But while Friday's headline might indicate the Canadian economy is faring well, digging beneath the surface suggests otherwise. And that's what we're going to do here, baby. We're going to see, because, again, we don't really know. We got to get second quarter GDP in. And you're saying that Canada's GDP is government and real estate. This train will not stop until it breaks. Oh, there are no breaks. But yeah, let's talk about the deeper side of this because obviously interest rates are going to they're in a good spot. I'm hoping interest rates get closer to 2%. That was my guess. I figure by the time they get through the interest rate cycle, we'll level off probably somewhere between 1.5% and 2%. And we're still at a good place here. I think 2.7 is not terrible either, but I really want to kind of get into the weeds of this and talk about like the effects that we're seeing in the banks, because the banks are showing stress from the tariff war already and loan losses. But before we do that, I guess we can take a look at the broader Canadian ETFs just to see how every sector and everything's doing, because it's pretty rosy right now. I mean, the Canadian dollar has bounced back by about 5% off its lows, which is not incredible. It'd be nice. I prefer the Canadian dollar to be closer to 80 cents, kind of go back to where we were during 2021, 2022 era would be great. But for the time being, it's just not fun to convert currency right now to US dollars. But if you have US dollars, it's really great to be buying foreign currencies. I've stated this many, many times that if you live in the United States, the best thing you could do is buy globally diversified investments that diversify your currency, because the dollar is at record level strength, like 20-year level strength, like record high almost level strength. It's crazy. But if we take a look, like if you were to put it in the Canadian economy, so if you put it in VDY as an example, this year you'd be up 3.66% on your US dollar on the stock that you invested in, plus you'd be up 5%. Just in the Canadian dollar difference. I think how much is, the Canadian dollar is up around 5%. So you make a double edge 8% return plus the dividends. I mean, you got to keep in mind this thing's yielding over 4%. So you can see how fast these returns can come in if the currency hedge works to your favor, but I don't play that game. It's kind of risky, but it's worked pretty well for me just buying US assets over the last 10 years. But again, there's no guarantee that happens in the future, but still VDY is crushing the US markets right now, 3.66%. As we're going to talk about the banks, HBNK, my favorite Pokemon book, because like Pokemon cards, you got to collect them all when it comes to the banks. This is my favorite equal weight bank ETF, and it's up 5%, showing some resilience here on bank earnings, hitting new highs. We're talking about the BMO Low Volatility ETF is actually up 11.68%. One of my favorite Canadian ETFs, is absolutely on fire right now. I don't own it, but I do like it a lot for the holdings that are in it. We got XCI here is up 3.3%. These really heavy dividend payers. XDIV, this one's up 4.76%. So Canadian economy, it's good to have some diversification. It's worked very well. And I think just because of the exposure to the Canadian economy and the global markets, I mean, XEQT, the honorable mention for a globally diversified ETF is up 2.61%. Not too far off the S&P. The yield's a bit higher on this, but you're still inching slightly better returns this year, having more global exposure. So diving into the Canadian banks, let's talk about the earnings. Let's talk about what's going on here, because the picture, it's not great, but people still seem to be thinking that everything's fairly dandy. Again, the banks some of these are pressuring all-time highs again, like Royal Bank. It did pull back a bit on its earnings. And I think Royal Bank probably had substantially one of the worst earnings, because they're saying that RBC and CIBC ramp up provisions for loan losses amid higher risks stemming from the trade policy uncertainty. And if we take a look at those loan losses themselves, these provisions for credit losses. So firstly, the earnings when it comes to revenue, you cannot deny that the revenue growth across the entire financial sector is astonishing, from 14.1 billion to 15.6 billion year over year. Whew, baby, still good growth. If you even look at the 6-month end, 32 billion versus 27 billion. No one's complaining except for loan losses that went from 920 million to 1.42 billion and are up 400 million just from this time last quarter. So this has a lot to do again with the trade policies, the concerns, the changing in capital, and because again, all these loans and mortgages and everything that these banks hand out is purely based off the income that is supporting the loan. So when they're worried about the income supporting the loan, they have to put these loan loss provisions aside. It doesn't mean that they're defaulting. It just means that there's higher risk of default. This money could be sitting in a bank. You want to look at impaired loans, which we're not going to get too deep into because they're not terrible right now for the most part. But that is a metric that gives you a little bit more insight. But overall, I mean, if you scroll through this, these earnings are still quite resilient. These banks are still heavily well financed, really strong balance sheets overall. Canadian Imperial Bank's retesting its all-time highs here. It hasn't seen in a little while. One of the best banks you could have bought on the dips. If you bought this last year, I mean, you crushed. It was one of the highest yielding banks. I think it peaked at around 8% in its dividend, or somewhere above 8%. If we take a look at the income as well, total revenue, 7 billion versus 6.1 billion, up almost a billion year over year. Provisions for credit losses at 605 million versus 514 million. So materially, even though loan losses are inching a little bit higher with CIBC, they're not actually all that bad. Not nearly as bad as Royal Bank's, at least, to say the least. So, I mean, again, you can scroll through this and take a look. I'd be curious to see what the payout ratios are at right now. Market value versus book ratio is up by about 1.46. Adjusted dividend payout ratio is 47%, actually lower than this time last year. So the payout ratios are still super strong. If we take a look at Bank of Montreal, this one's starting to pressure its annual high and pushing back toward its all-time high. We take a look at BMO here. Let's see how these guys are doing. All these banks posted in the last week for the most part. Revenue, 8.6 billion versus 7.9 billion. I mean, if we look at the year to date, the revenue growth on this one's not bad, 17.9 versus 15.6. Loan loss provisions here, substantially higher from this time last year, 705 million versus over just a billion. So loan losses, again, are still creeping. They're pretty much flat quarter over quarter, which is nice, but year over year is still pretty high. Not as bad as Royal Banks, though. And then finally, National Bank. One of the best performing banks just because it was a smaller company and went on a crazy growth trajectory. And I'm curious to why it's up so much on earnings, because I didn't see anything too crazy here. If we take a look at total revenue, 3.6 billion, pretty good overall for Q2 versus 2.7 this time last year. Like, the revenue growth is astonishing, right? But if we take a look at, again, the total provisions for credit losses, 545 million, which is up substantially from 138 million. I think what we should be looking at is probably like the net income numbers, just to see the growth here. Net income was 896 million versus 906 million. So their net income was actually down. If we do the same for, say, BMO, net income 1.96 billion versus 1.86. So BMO is seeing year-over-year growth. If we take a look at CIBC here, I think that's the one we're on, right? Yeah, CIBC, they have net income of 2 billion versus 1.7 billion this time last year, so they're doing pretty well. And then I think Royal Bank also got hit on their net income just because of the provisions for credit losses, 4.39 billion versus 3.9 billion. So still up, almost 400 million. I mean, like I said, overall, these numbers are still quite impressive. So there's nothing really to complain about, guys. I think we're doing okay. What are you guys saying? Well, what do you think of some of these stocks? I buy one every action for VDY, VFE, and ZEB. If I have 2K to add it, which one would you do? Not as financial advice. Personally, I think if you're looking for growth, I would stick to the United States. But honestly, you guys have seen my portfolio. I really only own 2 ETFs, which is the S&P 500, so VFE, but I own VOO, and VDY is my Canadian exposure. It just depends on what you're looking for. Obviously, I like the income from VDY, and I like being able to reinvest it when the markets aren't doing so well. So I really like having some of that income from those ETFs, and I like VDY because it's market cap weighted. But if you don't want that income, if you don't need the income, like ZEB is a much better performer overall for total returns. But it's purely up to you. I just like when the markets take a shit. I used to have SCHD for that as well, but I didn't. I kind of gave up on SCHD because the performance is starting to lack. But I do like having some dividends just to be able to invest when the markets are down, because it's not fun just owning growth stocks and then not having any extra cash coming in to reinvest. So, getting a 2 or 3% yield on my portfolio is kind of my goal. I think I'm around 2% or maybe even lower right now just because of some of my stocks. But yeah, or wait to go deep. But anyways, I should also mention here too with the other stocks in the portfolio, but thanks. Thanks for looking. I'm looking for my passive income and grow. Yeah, nice, man. But yeah, I want to mention Google one more time here because I was having a fun argument or discussion, not argument, but discussion with my mother about this stock because I've put a lot of money into it. It's materially one of our biggest positions, and I've been debating on buying more. I think I've got about 35,000 in this stock. I'm debating on taking it up to 50. I just don't know. Like I said, it's this debate of just putting it in ETFs versus individual stocks. But I feel like Google is sitting in a really precarious place right now where they're trading off a company that produces revenue from mostly advertising, right? And I think they're gonna go through a dramatic shift that's happening right now, thanks to what happened on Wednesday. And I think the street is severely under anticipating the growth potential. And if we see that growth potential, if they end up closing on 1 million users that are paying $250 each, I mean, that's a lot of money at 250 million a month. I mean, those numbers really start to add up real quick. So, I mean, if every business, and if you talk to people in advertising that have to do commercials, like VO3 is a game changer, the assistant, their AI assistant's a game changer. Like there's so many game changing products in that suite for $250 a month. So the question is can Google go from a traditional business of advertising spending and YouTube and ads and all this stuff to a subscription-based model? Because if they start justifying huge revenue growth from the subscription side of this, they all of a sudden become more of a SaaS-based business that is much more similar to that of Microsoft. And if Microsoft, being a more subscription-based business, can demand a 35 times price multiple, Google should not be sitting at a price multiple of 19. And they've proven to be an AI leader right now. And it's going to be neat to see what the other AI companies come out with to try and compete. But you got to imagine when you have ungodly amounts of money and basically infinite amounts of money and you're a money printing machine with great margins, like the sky's the limit here, right? So Google's proving they're not just some woke, stupid company with terrible employees. Like they've proven that they're not dying here. Like they're not going to die on this AI hill. They're going to take it to the ends, of the world here to try and make this work. So, and I feel like they are. So, like I said, I'm looking at it as this company should be trading at a 25, 30 times multiple. There should be easily, potentially 50% upside from here, at least in what I consider the fair value to be on this stock. So I think this is a fun individual play for me, but we shall see what happens. See, Google filled a mixed shelf offering end of April. Don't fully understand why they would do that, and buy back 70. Yeah, I have to take a look if they're doing some dilution to raise capital. It'd be interesting. Did they do that? You're saying that they did it at the end of April. Did they post that in a news report? Let's just take a quick look. Google Investor Relations. I'm sure I could just Google whatever. I don't want to see earnings. I just want to see news. Updates. What is going on here for April? First quarter, Google announces agreement to acquire Wiz, which is also a big deal. Presents a telecom. I'm not seeing any news in April from a shelf prospectus, if that's what you're talking about. So maybe I'm missing something, but it's not directly in their news. So whether that happened or not is to be said. Yeah, I'll have to take a look. I mean, you said that it happened in April, right? I don't know why they need to raise capital. They're sitting on $150 billion. Like they got more cash than God. The only next company with the most amount of cash to Google is Berkshire Hathaway, right? Which is crazy. There is a Canadian company that can process light and heavy rare earths. It's one of the very few that can do that. I am compelled to mention this to you on a bi-weekly basis. What is the stock, my man? The commodity space is heating up. It is heating up. But what's going on with you guys? What are you guys buying? Anything crazy out there? I mean, we've seen such a run up in so many good Canadian stocks. I mean, we talked about Aduro recently. They've crushed it. Aduro is one of my small cap plays that also support this channel. I've been working with them for like 3 years, and they've just been like one hell of a company in the plastic recycling space. They're on, I think, the bleeding edge of a technology that's largely under discussed. And honestly, if the technology starts proving itself and they convert clients here in the next year, the stock will easily rocket probably to over $1 billion in value. And it's probably one of my best small cap plays in the last little while. Done pretty well on it. Wish I owned a bit more of it as well, but to each their own, trying to play this the best that I can. Thoughts on Coreweave? Oh, Ucore. Is that the one you're talking about? Ucore, the rare earth company. Yeah, Ucore. I actually know the CEO, believe it or not. I work with him in other capacities. But yeah, they've been doing pretty well as of recently. I'll have to do a bit more of a deep dive on it, but I do actually have a connection to the CEO that runs that company, which is interesting. What about Coreweave? What is the Coreweave? Coreweave. This is an American AI cloud computing startup based in Livingston, New Jersey. It specializes in providing cloud-based graphic processing unit infrastructure to artificial intelligence developers and enterprises, and also develops its own chip management software. Very interesting. Yeah, I don't know. This it looks like it recently came public, and it's doing quite well. It's up 178%. $53 billion company already. What are their revenues, man? Let's take a look. Do they even have posted a quarterly? It'd be neat to see. Let's take a look. Coreweave financials. Are they going to make me pull up an SEC filing, or do they have it all listed here to make my life a little bit easier? We want the 10K, or are we going to get an 8K current reporting filing? I prefer to see 10. Let's see. Is the financials on their 8K here? Let's take a quick look, shall we? It's only a 302-page document. Let's see if we can find it quick. Because usually it's at the top here. If it is in the 8K anyways. I don't want to read the whole 8K. Maybe I could just pull it up on Yahoo and see what their current financials were. But it'd be neat to see the growth this company's having. I imagine they have some kind of disgusting growth going on. Do they have a 10K filing? They have to have a 10K, right? Statement of ownership, current. Find me a 10K real quick. There it is, 10K. Let's look at this. This will be easier. The 10K, folks, the most boring documents you'll go through. Here we are, total assets. They're sitting about $21 billion, $18 billion in total liabilities. So they definitely don't have a great debt to asset ratio, but that don't really matter if that, the assets that you own are bringing in ungodly amounts of money, and you have to pay for those assets because who knows what they actually were. But a lot of these are accounts payable, accrued liabilities, debt. I don't like their debt to asset, but let's just take a look. So the revenue was 981 million. Total operating expenses were $1 billion. So they're spending a lot more than they're making. Yeah. And they're doing quite a bit of dilution. Holy hell. I mean, they just go public. So, I don't want to, say that, they're going public. This isn't going to be a common occurrence, but the company did do a pretty sizable dilution period here over 2024, just in 2025. I don't know. I got to be careful with this company. They're worth a lot, 50 billion, and they're making absolutely no profit, and they're barely bringing it. So they're doing about 4 billion. So they're trading at what? 4 billion annualized against a $50 billion market cap, no profitability. Whew, man, they better have some crazy growth trajectory ahead of them. To be trading at a $50 billion value, that's quite extensive, man. That's over 10x, I guess, just revenue, but the revenue isn't proving to be profitable. What are they spending all this money on anyways? Sales and marketing, not a huge expense. They're only spending 10 million on sales and marketing. Wow, that's not a whole lot. It did jump up a lot over last year. Technology and infrastructure, they're spending, a lot on technology and infrastructure. So they're obviously, half their income is just going to the infrastructure they're clearly building out. Do you speak in French? I absolutely do not speak French. I think it is, at this stage of Canada, a ridiculous language to be considered the second language of Canada, when I think it is more prudent to learn Cantonese or perhaps Hindi, Gujarati. There's so many other languages that are more prominent in the major metropolitan areas of Vancouver and Toronto than French. Actually, good luck. Go to Toronto and find someone that speaks French just by walking around the street. I'd be largely impressed. With the exception of Quebec, we are definitely beyond English and French at this point. Have you finished paying off your damn condo yet? This is a debate that we constantly have right now. I'm waiting until the mortgage renewal comes up because I don't see a point in breaking the renewal to pay it off. And I talked to my accountant recently, and it's going to be something that we're going to try and figure out how to manage once my my mortgage renewal comes up next year, because there's no reason that we can't pay it off. It's just I have to figure out what the best way to get my hands on the cash in the most tax efficient manner is. And I could pay a lot less tax by having my corporation just pay out a dividend. So like we've been debating on the sizable amount of cash we're gonna have to get our hands on, and if it's worth just pulling a little bit out of our TFSAs and then a large portion out of my corporate account and just biting the tax. And a lot of people said, well, why would you bite the tax? Why not just leave it invested? And my concern is like, if I'm not paying it in tax, I'm paying it in interest, right? Because I mean, I'm tired of looking at the bank making like 10, 15,000 annually off interest payments. It just doesn't, it makes me feel gross inside when I see the bank making money off my money. I don't like it. So yeah, I don't know, probably pay it off next year sometime, if it makes sense. And it does make sense. I'm like Dave Ramsey. I don't want to have a mortgage. Who wants to have a mortgage? So I mean, if you have the capital liquid within means, I don't want to drain our TFSAs. So it's trying to find that balance. I told you guys that it's like, for every dollar we put on the mortgage, I want $1 going toward the portfolio. So our asset value toward like real estate to stocks is exactly the same. But I mean, we're in a good position anyways. Like, it's not like, to have this problem of all the problems in the world, like, is the most privileged fucking problem to have. It's like, oh, I don't want to pay tax to pay my mortgage off. Heaven forbid. Oh my God. Is there another ETF like VDY? Yeah, lots. I just talked about them. Go back to the beginning of the stream. XCI, XDIV. Like, there's a lot of great ones out there, but personally, I just like VDY. I like market cap weightings. So it's just my thing. I live in Quebec. That's funny. So for the French side of things, he's Ontario. Of course he doesn't. How much trading can you do in a TFSA before you start getting audited? So the rule of thumb with the TFSA, firstly, you can trade all you want. They only care if you make money. If you don't make money, you're never going to get a filing that says, oh, you're day trading, stop doing this. No, they're going to be like, you lost money. Haha, sucks to be you. But if you make money, basically they just don't want your TFSA to be operating as a business. That's the way they look at it. So I've talked to a few people about it that have had to deal with getting charged. And basically anything that you can do, like even if it's options trading, if you do it methodically, you could probably get away with it in a lot of ways. Because I know some people that have made some major options trades and pulled millions into their accounts within the last year. And they're really worried and they're pretty confident that they're going to have to pay tax on it. But just don't day trade. Like, you can even trade every other day technically. It's just so long as you're not doing trading on a daily basis. Like, if you're not going in and every day buying and selling like 6 different stocks and doing it over and over again, you should be able to get away with it. They just don't want you to be doing active trading. So swing trading's fine. I've done a lot of swing trading in my TFSA, but my definition of swing trading is anywhere from like 6 months to 3 years, right? I'm a boring investor that way. Have you seen Killam recently? Up 15%. Really? The Killam REIT? Let's take a quick look. Yeah, the Canadian REIT sector, and I will state this again, and I'm only stating this out of the protection of your own money, because I know a lot of people like the REIT space, but you got to ask yourself a very bold question here. So there are some good REITs. I think Cap REIT's one of the best, but when you look at the total returns over the last 10 years, you have to really ask yourself, how have these REITs, in the greatest real estate value expansion Canada has ever experienced, how have these REITs not tripled in value when the underlying real estate has basically tripled in value? So I mean, from basically from like 2015 onward, like the real estate values ballooned. So Cap REIT went up 128%, but overall is only up 54%. But if you bought a house in 2015, what would the value of that house be today? It probably have, doubled or easily tripled your money, right? So you got to really ask yourself why the underlying fundamentals of these REITs haven't improved as great as the real estate value has. And if you start going down that rabbit hole, I promise you're going to see some pretty nefarious shit. I mean, there's a lot of corruption in the Canadian real estate space. And I don't know how much I want to get into it because I've had a lot of privileged information and I've seen a lot of weird shit. I don't like the REIT space anymore. I did like Rioan for a while, but man, when you see you can read it in the newspapers. Like, there's people that would buy historical sites for $1 million in Toronto, burn them down. A guy got caught doing this, literally caught doing this. He would burn them down so it was no longer considered a historical site, and then sell it to a condo development company for like 10, 15 million. 10x your money instantly. Just go buy a historical place where they can't develop, burn it down accidentally. I I mean, look at COVID too. I think another really funny thing that I heard was that like during like, I mean, did you hear about all the construction companies that were going under? Were they really going under during COVID and the interest rate cycle? Think about it. You got a construction company that basically you had to give a deposit to for like 5 years. They developed the condos and then said, oh, we're going bankrupt. We can't afford to finish this. So what they would do is refund the money, basically go get a loan from a bank, refund them the money with the loan, and then rent out the condo building. Like there's so much stuff that these people were doing. And like, it's just, you got to be really careful. I don't want to buy new. I mean, you got to be real careful buying new condos. You really need a good lawyer. The only thing you want to own is old condos in the city because they're built for comfort. You really just want to own like townhouses, which have exploded in value. I mean, townhouses have gone up like 40% year over year now because anything that's comfortable is where people are running to. Yeah, I like Rioan because I like the property they own, and I think it's underappreciated because there's no new development that can really go on in the city anymore. There's no new land, and Rioan owns like the most amount of square footage in Toronto because it owns all the malls. And if they ever just wanted to convert all those malls to something else, maybe, I don't know. That's why I see value in Rioan. But at the same time, like, again, ask yourself the question. If Rioan owns the most valued properties in Toronto, why has Rioan stock not gone up the same way Toronto real estate values have gone up? And again, the deeper you look into that rabbit hole, the more you're going to learn that management wants to make money off these companies. They don't want to pay it out to shareholders. Like there's so much corruption. Bro, I subscribed to you on my other channel and completely forgot about you until last week. I was wondering why I hadn't seen you subbed on 2 channels now. I appreciate that greatly. I do appreciate all the subs, guys. Yeah, things are going to change here soon. I guess I mean, we're half an hour deep into this. I don't know if it's worth getting this deep. And my life is evolving. And I'm like, and I don't know what the state of this channel is going to look like in the coming year or two, but I'm eventually going to stop showing the amount of money that I'm showing you guys. Cause like I was talking to my fiance about this. Cause like, it's fun showing the journey on the way up. But when you get to a place where you're making really good money at your job and like, you know, your portfolio is getting to a place where like, you don't really have to work that much if you don't want to. I don't know how many people out there do you know are showing like multi-million-dollar portfolios and stuff, right? Like it's already hard enough because like I don't want to show my wife's accounts, and it's really hard to talk about my portfolio without talking about her portfolio because like we invest based off like what we're both doing, so we don't like over concentrate or anything. But then comes the other problem of like I've been recently like Googling my phone number and like Googling my address and just being like, because unfortunately, like some of the companies I work with, they have to like publicize your information. And it's sketchy when you're like, look at all the money I have and look at all the shit that I've accomplished. And you guys can just figure out where I live. And like, we were just talking about too, like I used to own a really nice car back in the day, like a reasonable car, but I used to like to put decals and like put a lot of shit on it. But when I go out, like I like being invisible or having anonymity. Not that I'm saying I'm like famous, like by any means. I just like, there's something weird that the more successful you become and the older you get, the least you want people like being aware of it. And it's weird saying that considering I just put it all out here. Like it's been a really great educational piece, I think. And it's been fun doing this for my own personal journey, like my growth. Because I started this channel and I barely had $100,000. I literally started this channel because I hit 100K. And that was in 2019. I was still with my girlfriend at the same girlfriend at the time. And we were both like not that well off, like still figuring out the job stuff and everything. And now we're like combined millionaires. And like, you know, we really don't have to worry about job security anymore. Realistically, you know, we'll have our mortgage paid off before we're 35. So it's just weird. It just becomes weird that like, you know, you hear about all these all the fundamentals you need to get rich, which isn't hard. It's just frugality and consistency in investing. Like do that for 10 years, try and put away 50% of your income, which has been my goal. And in 10 to 15 years, you'll have enough money to retire. At least that was the thought, the process behind it. No guarantee, obviously, because you need the market conditions to back that. And there's no guarantee the markets go up as consistently as they have, but they did. I mean, we've been in the greatest growth period in any market ever. The millennials, my generation, literally had the best growth of any generation before us in real estate and in the stock market. And the only people that lost were the people that weren't part of the investing class. I'm so happy I started when I was 23 because again, like I'm not Jeremy financial education like Rich or like Meet Kevin like Rich, but hell, like if you just, put a little effort in, you didn't have to be the biggest YouTuber in the world or even be a YouTuber. You just had to be consistent. So yeah, it's crazy that it works, guys. Like I hear everyone complaining to me, oh, you can't do that again. Like, oh, like Canada doesn't want you to be rich. Canada's a broke country. It's becoming a third world. It's like, I'm not telling you guys this stuff that, because like I'm just trying to get clicks either. I'm telling you this because it works. I'm like prime example here. Like it works. I mean, please get Pat Ryan on. If you don't get you to do it, I bet you can get Ryan. Yeah, the independent investor to do it. I want to move to Canada and I need money to do it. As long as your comments throw me off here, do it. I move to Canada and I need money to do it. So as long as you yeah, I'll get Ryan on. Me and Ryan should do a collab again. I still talk to him all the time. I watch a similar branded named channel, Passive Income Investing, who shows his $2 million portfolio on covered call ETFs. Yeah, he's done really well with his channel on the covered call ETF side of things. I found that most of my channel success isn't on my channel. It was through the connects that I have through my channel. Because like I said, like this isn't my full-time job, but it's the result of my full-time job. So it's kind of a weird thing to consider because like I couldn't live off AdSense, but I've met some companies and I've gotten some sponsor deals and one thing leads to another. And, my skills can translate beyond this YouTube channel and I get paid to basically do something very similar to what I do on this YouTube channel, but for other people. I agree, man. Most people are broke because they are trash with their own money and nothing to do with the government. Like I said, the Canadian government has made it so easy to get rich. And everybody I know that is like, I literally talk to people that are worth $5 or $10 million and they're like, I don't know if I could have done this in another country because of how lenient the tax laws are here. And and I showed you guys this before, right? And I'll just reiterate this. One of the most valued things, if you want, like the two most useful tools that are the most simple, that I think the only tools you'll ever need is the Wealth Simple tax calculator and a compound interest calculator. You don't need anything else. And then you can go out and find the investment vehicles that match your goals and what you're trying to achieve. But like, if you look at the Wealth Simple tax calculator, and the reason that like the rich here say that it's easy to maintain being rich here, and we'll use Ontario where I live, which is one of the most taxed provinces in Canada. But let me just show you again, like if you make $60,000 in employment income, you're paying $13,000 or $13,000 in taxes, right? But instead of making employment income, if you just had dividend income, like eligible dividend income, you would virtually pay no taxes. You pay $750. And then again, do the comparable to like capital gains. So let's say you were employed and you made $500,000 in employment. You're going to lose half of that almost to taxes. You're going to pay $228,000. But if I made $500 million in capital gains, how much tax would I pay? Oh, I would pay $113,000, almost half as much in tax. And if I were to make $500,000 in eligible dividends, how much tax would I pay? Oh, I would only pay $154,000, so just a bit higher than capital gains. So like, you're saving such a god awful amount of money. Like if you just make money as an investor, rather than, an employed salary. The salaried employee in Canada subsidizes the entire country. So like if you can start figuring out how to start a business, do side hustles, write off some income, get some investment income, max out those accounts, and then you can go to a compound calculator and you try and figure out what your time horizon is. And you say, okay, like I'm making, I'm making $100,000 a year after tax. It's like, I don't know, let's just say after tax income is like 75,000 and you're able to put, I don't know, what's a reasonable amount of that? Like 35K. Let's say you can put $35,000 away a year. You're a fucking G. You're crushing it. You're putting more than 2,000, 2,500 away a month or something like that. And, you're able to grow it and you want to say, I want to do this for 15 years. I don't want to do this forever, but 15 years. And I want like a 10% rate of return. I'm going to be $1.2 million in 15 years doing this. So what investment vehicles do I need that will make me a 10% return historically? So you look at something like VOO and you go look at VOO, the fact sheet here. We go into the ETF and we scroll down and we say, okay, well, here's a company that's like the S&P's been around for 100 years. Here's a market cap weighted ETF that is actually since inception annualized 14.24%. So it's actually done far better than 10% by almost double that. I mean, it's a 40% more return, right? So you're like, oh shit, well, if that continues, you go back to that compound calculator and you're like, oh, maybe I get 14% instead of 10%. Damn, that's 1.75 million. And heck, maybe it doesn't work out that well. Maybe I only make 8%. Well, damn, that's still $1 million. So like, these are the only tools that you really require as an investor. Like, you just need to understand what your goals are, your time horizon, your income, how much of that income you can save. And then you can start tweaking the dials, as I have done. You can start getting into corporate investing, start a corporation, and just the rabbit hole goes deeper. And that's where you start getting like into the mega wealth side. I think those are like the final bosses, the final tier of wealth building is understanding corporations and tax loopholes, not tax loopholes, but just tax laws that allow you to save more money. Because even still, if you make money in your corporation, you pay yourself a dividend, you're still going to be paying out a lot less probably in taxes. I have a YouTube question. Not sure if you'd be willing to answer. I have 6,000 subs, talking stocks too, but I want to get sponsorships. Any clues on how to get that? What's your channel? Is it Health and Wealth? Or what's your channel? Tell me your channel right now, and we'll share it with the group here, and maybe reach out to me. Maybe I can get you some sponsored work. Because I work with a few channels like me, Ryan, there's a bunch of other channels that I work with, and we kind of throw work around, but maybe I can give you a trial understanding to how all this operates. Maybe you made the right comment on the right YouTube channel at the right time. I could be your first sponsor. But yeah, so yeah, health, wealth, and mostly a high yield distribution pair. When we withdraw from a TFSA, do we get that contribution run back? Yes, you do. Actually, that's one of the loopholes that one of my buddies pointed out, that if you really want to take advantage of a TFSA, when you've made a lot of money right at the end of the year, you sell off your entire TFSA, you pull all the money out, and then when the year turns over, you've extended your contribution room. So any money you pull out of your TFSA, the following year, you can recontribute back. So if you hold stocks, and let's say your account, your TFSA goes up, let's say you put 50 grand in and you double it to 100K. That isn't your contribution room. You don't own that contribution room, but let's say you have that 100K, but the stocks drop and they drop in half back down to 50K, and you sell it and pull it out. You can't just put 100 grand back in because you had the capital gain on paper. But if you actualize the capital gain and pull it out and then put it back in the next year, you literally raised your contribution room to 170K. It's kind of anecdotal though, because you're just going to invest it all again anyways. And if those stocks materially go down, you're still going to lose that money anyways. But anecdotally, yeah, you whatever you pull out, you get to put back in the following year. So you start a corporation and start investing. I only recommend, so I think it's more prudent to start perhaps with a sole proprietorship, start a side hustle, start taking advantage of write-offs. Corporate investing is something you really only want to start looking into if you've maxed out your RSP, your TFSA, your FHSA, all that stuff, and you have a side hustle that's producing maybe $50,000 or more. It's really hard to justify a corporation unless you're profiting at least 50K, because the accountants are more expensive, the account fees are a bit higher. And yeah, there's a few other costs that are going to be implemented, but then you also have to look at capital expenditures, because you're still going to utilize write-offs in your corporation. But if you can profit like 30 to 50K, yeah, it can start being worth investing. Like I think in my corporation, I've got about 140 or 50,000 invested right now. And it does protect that money a bit because it's a third-party entity. I'm just 100% shareholder too. And as an example, like having that liability risk kind of taken off your back, it's nice to some extent, because if I have a car accident, somebody can sue me for my money, but they can't sue my corporation, and same vice versa. Or if, let's say my wife, you get into a really bad divorce or something, right? Like she can't come after the corporation. I own 100%. I'm the shareholder. Like, it's not like the United States. So like with Jeff Bezos, it depends on the provinces, the states you live in. But here it's like, if you love your wife, guess what? It is a lot easier in death to give her the shares of my corporation and have her become the share owner of the corporation than it is for me to give her my TFSA or move this money around. And there's a lot more tax implications with having to move real estate around. But if it's all in a corporation, she just absorbs my shares and there's no tax liability. So there's a lot of weird things that come into play when you get down that rabbit hole. But I promise you that, like I said, it's the final boss. But the only way to achieve the final boss is to start a business where you start making substantial income and you're able to take advantage of that stuff. Because if you don't, like I said, if you're not making 50 or 100K a year at least, it's just not worth doing. You might as well just be a sole proprietor, keep focusing on your TFSAs, and just start writing off parts of your property, your food expenses, et cetera, et cetera. So where are you putting, anyways, what do you think about Corby Wines and Spirits? Would you take out your money to pay an initial for a threeplex, or would you save money to raise for the initial? Sorry, what's the question? Would you take out all your money to pay for a threeplex, or would you save money to raise the initial? I'm curious to what you mean by that. I liquidated my TFSA to buy my property, but a threeplex, I don't know. What do you mean? Where are you trying to liquidate it from? Would you take out all your money from your TFSA to pay the initial for a threeplex, or would you save the money to raise the initial? It just depends on what your goals are, man. I'm not a real estate guy, so I don't want to own any real estate. I don't like the idea of owning rental income properties or whatever. I didn't even want to own this condo. It was more feasible from a cost perspective if we owned it over renting it. But yeah, for a threeplex, I mean, do the math. Like if you think you're going to get a higher rate of return off that property, then yeah, liquidate your TFSA for sure. And if you can outright own the property with what you have in your TFSA, that'd be wild. I doubt it. But I mean, if you need the deposit, yeah, go for it. I liquidated my TFSA just as long as you can build it back relatively quick. I mean, I've almost maxed my TFSA out in a year and a half after liquidating it. So I feel pretty good about that. I could max it out, actually, if I could pull more money into my corporate account, but taxes, man, I don't want to pay taxes. I just leave my money in my corporation and let it fester, because I could use it like an RSP down the road, and down the road I could just pull it into my name and pay tax on it later. Meanwhile, let it grow. I have maxed out my TFSA and RSP and FHSA. What do I do next? I have an incorporation. I do it there, or do I open a non-registered personal trading account? Do non-registered, again, because you can see that if you have qualified dividends. So when I showed you the tax implications of qualified dividends, that is not in your TFSA. So, I mean, that's the kind of redundant hilarity behind it, is people are like, I need to own Canadian stocks in my TFSA. It's like, if you're owning Canadian stocks for dividend income, there's no real reason to do it, because you're not going to pay any real tax on a qualified dividend anyways if you're making less than 60K or 50K. So yeah, I mean, you can start, if you've maxed out your TFSA and RSP, you're basically at my parents' stage. You're in that retirement stage, and you're asking yourself, what is the most tax efficient way to cash flow income? And you look at the tax implications, and you're better off owning US dividend stocks in a TFSA and own your Canadian dividend stocks outside of the TFSA, because the US dividends and the US in general is getting taxed more, and it's more efficient in the TFSA than the Canadian dividend stocks would be. So, I mean, keep that in mind, I guess. I don't know. You're in a good position if you've maxed that out. Good for you. You're privileged. You have the problems the rich have, which is, how do I get more tax efficient now? What do you think about Dollarama? It has been on fire. I owned it once, I sold it once, and I regret it greatly. Would you get into Brookfield? Yeah, Brookfield's great, especially now that Carney is elected, and he's favorable toward, he owns options still in Brookfield. So yeah, I mean, BN, how's its stock doing anyways right now? If you want to get on anything the government owns is done pretty good. And Brookfield is like a conglomerate. I mean, look at it. It's done great. The last 5 years, you've doubled your money. If you bought some of the dips here in 2024, you've done very well for yourself. Doesn't pay much of a dividend yield, but I wouldn't be buying this for dividends anyway. And comparably, I mean, it has, I think, outperformed the broader Canadian markets quite greatly. I mean, it has done quite well. I mean, over the 5 years, it's given you maybe an extra 20-30% return. And since if you go way back, it's done substantially better. But do you think more oil and gas infrastructure will be built? The tone seems to have shifted lately. So yeah, I mean, they're already building a lot more oil and gas, regardless to what people think. I mean, Canada wants to become a net exporter of natural gas and be one of the powerhouses globally in natural gas. That's one of the reasons that you've seen a massive explosion in Canadian natural resources. Canadian natural resources has one of the largest natural gas deposits in the world. And when natural gas started becoming a big deal, so did this company. And they've unlocked a lot of that value, and they're greatly increasing those wells right now. They've been doing really well on the back of a very low oil market price, but that's because they've been able to like bump up production so much. But Canada is building out like massive export capabilities. Didn't the Canadian government invest like $3 billion or something ridiculous into a natural gas facility for exporting? I mean, there's a lot going on with commodities in Canada that way. So yeah, I don't know. Why are U.S. dividends better suited for TFSA over RSP? So I'm talking about like later on, let's say, because eventually you have to liquidate your RSP, right? So like my parents, for example, don't have RSPs, and yeah, they're gonna have to pay a 15% withholding tax over, say, over the RSP. But I told my mom, like, is it really that big of a deal to pay a 15% tax on the dividends, and that's all you're gonna pay? Because if you own U.S. dividends, they're not qualified dividends. So if you own them outside of your TFSA, I mean, it's still going to be cheap, but they're not tax efficient anymore, right? So like that's why you're better off just biting the 15%, getting the diversification and owning U.S. stocks. Thoughts on? Okay, yeah. So we were just talking about this with my mom. The best stock she ever bought in her retirement was British American Tobacco, and I told them they need to get their money back from the smoking they've done over their lifetimes. I mean, my mom doesn't smoke anymore, but they smoked, and I said, man, these are great companies. I would never buy these for growth. I told my mom, like, don't buy British American for growth. Don't buy tobacco companies for growth. I hate MO, by the way. Stay away from MO. Altria Group is the worst tobacco company. Philip Morris is the second best. British American is the first best, in my opinion. Even though Philip Morris is, if you look at the stock, it's done much better. But I honestly don't think Philip Morris is better than British American Tobacco. I think British American, just from a fundamental standpoint, is better. But she bought this stock my mom bought this in October. Where did she buy this? She retired. Where did she retire? Somewhere over. I'd have to take a look. I know she's up substantially. I think she was buying right in the lows here. I think it was October of 2023, somewhere around here, I want to say. Like, she's easily doubled her money on this company just from the dividends. Maybe not doubled. I mean, that might be a little bit exaggerated, but she's easily up 50%. Because I think when we looked at it, she was like, her capital gain in this was ridiculous. But yeah, I like this company for income. It pays a great yield. It's a very reliable yield. I wouldn't buy it for growth. The tobacco sector is just one of those places where, like, you're still going to have people smoking, but that's kind of reached parity. And the number of smokers has been, I think, overall dropping globally, but definitely dropping, like double-digit dropping in the Western world, which is why you don't want to own MO, because MO is primarily exposed to the United States, and it has just been getting devastated. It's funny, you look at the stock price and you're like, oh man, the stock must be doing so well. But when you go look at the actual, like, maybe I can just pull it up quick and show you what I'm talking about. Because if you look at the percentage of sales, like just plummeting, and they're just increasing prices to keep up with the losses. So you're kind of like tricking investors, making you think it's doing better than it's doing. Financials, where is the, so I'm looking for, I don't want the 10K. Can I pull up the presentation? Let's see if I can find it here quick. Where is the presentation? I got to pull it up and I'll find it, because I don't want to look at the balance sheet, because this is just going to show you the sales. Like, I don't want to look at the sales. I want to see the actual, because in their presentation, they show you how many sticks are sold of cigarettes, and like, it's literally dropping by double digits. I'd really like to find that data, because I don't think it's in here, is it? It's not. Where is your investor presentation? We got financials, return on capital, fixed information, dividend income, annual reports. Let's take a look at annual reports. This might be more helpful. Presentation. Let's see if it's in this. Let's take a quick look here. Is it in the annual report? Probably not. Absolutely not. Anyways, yeah, if you guys can find it, go into it. It's worth looking at. It's definitely interesting, because you can definitely see that, the tobacco sector in the U.S. is dying. It's dying really, really bad. And same with the alcohol space. The alcohol space is starting to deteriorate a bit. So yeah, but anyways, we've been floating here for a while, folks. I appreciate the 170 that have stopped in, and I hope you learned something this evening, as always, as this world evolves and as the world changes for me, and I'm sure yourselves. I hope it's only for the better, but stay cool, stay awesome. And as always, I look forward to catching you in the next one. Peace, folks.